As you may know, there was recent tax legislation put into place that has many caveats that could affect how you go about your tax planning. So today, I'm going to dive in and break down what I think are some of the most impactful policies for the most broad range of people. While this new tax bill is comprised of multiple components and has already garnered the interest of the retirement industry for a variety of reasons, I'm going to try to break down for you and simplify some of the key terms that I have found in reading through it. And here's why I think this is not only important, but also timely. Some of these key changes are set to phase out over time, with some of them ending in 2028 and some ending in 2029 as they stand currently. With that, my overall hope here is that you're going to be able to take away some useful information from this video and put it towards your tax planning in an educated manner. Let's start with one of the most overlooked pieces to this puzzle that I see. And that is the temporary expansion of the state and local tax deduction, or the SALT cap, which could potentially be useful for those retirees in higher tax states. If you own a home in a place like New York, New Jersey, or even California, this is something that I think you're going to want to pay attention to. The SALT deduction allows you to deduct state and local taxes from your federal income, such as property taxes, state income tax, and some local tax. For many years, this deduction provided meaningful relief for those particularly living in higher tax states. With this recent legislation put into place, the SALT cap was expanded from $10,000 up to $40,000 for those with a modified adjusted gross income of less than $500,000. This is a substantial increase on the cap, and depending on one's particular situation, this could have a dramatic impact on your tax planning. For example, consider a retiree who lives in suburban New York paying $22,000 in property taxes per year. Under the old cap of $10,000, only a portion of that $22,000 could be deducted annually. However, with the increase in the cap up to $40,000, now the full amount of $22,000 can be deducted. The result of this change could amount to thousands of dollars in annual savings depending on one's situation. And in my view, this is particularly relevant to retirees living on a fixed income. For every dollar saved is another dollar that you could theoretically put towards something like healthcare costs, groceries, or even just going out and having fun. Another example, if you're a couple living in the state of California and you have $15,000 in property tax and $10,000 in state income tax, you can now deduct that full $25,000 under the new cap. It is important to note though, not everybody will qualify for the full $40,000 deduction. This extended cap starts to phase out for taxpayers with modified adjusted gross income over $500,000, being reduced by 30% of the amount over the threshold, eventually reverting back to the $10,000 cap. When it comes down to planning, something that I focus on is reviewing one's income sources, timing of withdrawals from their pre-tax account, and trying to figure out how to take full advantage of these deductions when working with their accountant. As it stands right now, this SALT deduction cap increase is only temporary, and it is set to change back to the $10,000 limit in the year 2029. And while this SALT deduction change could offer a great tax break for many, it's only one piece to the puzzle when it comes to retirees and what could help them. There's another provision, which in my opinion targets one of the biggest pain points for retirees, which is taxation on Social Security. The $6,000 senior deduction is something that could help potentially reduce or even eliminate the tax on Social Security that they pay each year. If you're age 65 or older, this bill could potentially have a great impact for your situation. And if you're married, you could deduct up to a full $12,000 annually. This $6,000 deduction per eligible individual is available whether you itemize your taxes or not, which is particularly attractive to a more broad range of retirees. For single filers, this deduction is available if your modified adjusted gross income is $75,000 or less. And for married couples, the full $12,000 deduction applies if your modified adjusted gross income is less than $150,000 per year. If your income is above these thresholds, this deduction does phase out over time depending on your income limit. To see how this plays out, let's take a look at a married couple with a modified adjusted gross income of $140,000 annually. Under the old rules, their Social Security could theoretically have been taxed up to 85% of the total value, depending on their sources of income. With this new deduction, they can now lower their income by $12,000 annually, which could substantially lower their Social Security tax liability. This change has the ability to potentially reduce taxes by thousands of dollars annually. And for those retirees that are focusing on things like healthcare expenses, cost of living in general, groceries, and other items that might be facing inflation, this could be particularly useful. Similar to the SALT cap expansion, it's important to note that this is another change in this bill that is only temporary as it stands today, phasing out in the year 2028. Next up is car loan interest, whereby this new bill allows you to deduct up to $10,000 of interest on a loan for a qualifying vehicle. To qualify, this must be a new car purchase, and the car must be fully assembled within the United States. cars assembled outside the United States, or leases don't qualify. And as with the provisions I listed earlier, income limits do come into play as far as how much of the deduction can be taken advantage of here. This deduction begins to phase out for earners that are single filers that are earning $100,000 or more. In addition, for married filers making $200,000 or more of modified adjusted gross income. In simpler terms, the phase-out decreases for those income limits I listed previously and disappears completely for single filers earning $150,000 or more and for married filing jointly earning $250,000 or more per year. For example, a single retiree earning $100,000 a year paying $6,000 in interest on a loan is fully eligible for that deduction. However, if that person goes above $150,000 in income, there is no more deduction for them. And if you've been weighing the pros and cons of buying versus leasing, this could come into play for your particular situation. In focusing on the younger generation, something that I want to hit on that I haven't seen getting too much coverage is the changes that are made to the 529 plan. For anyone not aware, a 529 plan is a tax advantage plan geared towards educational spending. The recent expansion of eligible expenses for the 529 plan now includes things like homeschooling, professional credentialing, and even tutoring. And this next feature makes me very excited. As you may or may not know, I'm a major proponent of saving. Children born between the dates of January 1st, 2025 and December 31st of 2028 are now eligible for a savings account geared towards children, similar to an individual retirement account or IRA. These new accounts, set to launch in 2026, will receive an automatic $1,000 government contribution and will have $5,000 contribution limits per year. These accounts are set to be like individual retirement accounts for those under the age of 18, which have a variety of differences from current savings plans for children. And what makes these accounts particularly unique is the funding sources that are allowable. Not only can family members contribute, but employers can contribute, government sources, as well as nonprofits are also allowed to contribute money to these accounts. For example, an employer will be eligible to contribute up to $2,500 per year for a dependent of one of their employees, and this will go towards the $5,000 contribution limit, but it will not be counted as income towards the child. This feature distinguishes these type of accounts from other IRA-type vehicles, where employer contributions are usually counted towards income. Any funds contributed are essentially locked in until the child turns 18, at which point these accounts automatically convert to a traditional IRA. So from that point on, the new account then follows all the same rules as a traditional IRA as far as contribution limits and withdrawal restrictions are concerned. Also important to note that investment restrictions may be imposed on these accounts in an effort to try to protect the child from investment risk over time. Once the account converts to a traditional IRA, however, at age 18, the child has free range to invest in whichever manner they want. Let's look at how this might work in practice. A grandparent contributes $5,000 annually on behalf of their grandchild from birth up until age 18. In addition, the account receives a starter from the government of $1,000. Over the course of those 18 years, this amounts to about $91,000 in contributions and hopefully experiences growth and compounding interest over time, which could grow substantially from there. And while the exact outcome can vary for a multitude of reasons as far as the account is concerned, this could end up providing a wonderful base by the time the grandchild ends up reaching retirement age. In addition, one other thing to note, the contributions to these accounts do not affect those that are making the contributions, whether from the parents or the grandparents, if they are contributing to retirement plans of their own. This means theoretically, you could help fund your grandchild or child's future without jeopardizing your own retirement savings. And for retirees that have the means to do so, this could also be particularly attractive as it could provide another pathway to transfer wealth to the next generation. And to expand on the idea of wealth transfer, this new legislation also brought change to the federal estate tax exemption. This number was set to drop almost in half in the year 2025 to about $6 or $7 million, which as far as I'm concerned caused a bunch of scrambling happening over the past couple of years. With these changes, the new limit for individuals is now $15 million, and for married couples is $30 million when it comes to the federal estate tax exemption. Important to note here, these changes are actually permanent, and they will start to adjust upwards for inflation starting in 2026. Now, with all of these changes taking place, it could be an opportune time for you to meet with your team of trusted professionals, whether an accountant, an advisor, or even a tax attorney. And in my mind, this new tax legislation is more than just a bunch of tax changes. This presents opportunity, and I feel could be catalyst for change and reason for reviewing your plan. Being informed and remaining nimble can be positives in a changing landscape. And because eligibility and phase-outs can be complicated, meeting with your accountant and going over your plan could be beneficial for you. If you're trying to get all your ducks in a row and don't know where to start when it comes to retirement planning, check out our next video here.